To succeed as an investor or trader in the crypto markets, you have to separate the what from the when. What does that even mean? It means that there are truly great crypto projects, world-changing projects, that will still drop 90% or more. We have a lot of seasoned investors here on the channel with 20 or even 30 years of professional investing or trading experience. And this fact takes even many of them by surprise, because it's different with stocks. A share price will not drop below the point where it's obvious that it's too cheap. Why? Because then someone can buy the whole company. If the company makes money and you buy the whole company, you make money. It makes sense to buy the whole company if it costs less than the net present value of future cash flows. In crypto, this isn't the case for two reasons. Number one, the coins are not shares. You don't have the right to the company cash flow. Compare Ripple versus XRP, for example. Number two, and more importantly, it makes zero sense for someone to buy the whole project, all of the coins, if they are too cheap. If one person owned all the bitcoins, they would be worth nothing, unlike the stocks. But if it is a great project, the coin price shouldn't drop that much, right? Wrong! It doesn't work like that, guys. We don't have to back up that far. Ethereum in 2018 dropped 95% within that year. And I don't think there's anyone, except maybe a few Bitcoin maximalists, claiming that Ethereum is a useless project that has done nothing good for the world. Still, it drops 95%. And then it goes up 5,000% in less than 2 years in one parabola. The mental model you have to maintain to survive this industry isn't how much is it worth. That will lead you wrong. Instead, you have to approach this from the behaviors of the buyers and the sellers. Price dropped because large holders sold. That's it. That time Ethereum dropped 95% only. That's a factor 20. Only. It could have dropped more. That time many large holders sold, for example ICO projects that had raised a lot of funds in ETH and were now running out of money. But some ICOs with huge amounts of ETH decided not to sell. If they had sold as well, price would have dropped more, probably something like 99%, which is not unreasonable at all looking at this chart, which is a factor 100. And that could have led to more panic, more sellers, and it could have gone to zero or almost zero. Still the same project. No difference to the fundamentals, or the operation of the Ethereum blockchain, or the development, or the operation support, or the ecosystem, or anything else. Now we are in the exact same situation again. Almost all the really great crypto projects that I really like have had huge drops in coin price. Bitcoin BTC dropped 63%. Ethereum, the leading smart contract platform, the ETH token dropped 65%. And that's the flight to safety projects. If you look at Thorchain RUNE, an L1 DEX that I've covered, their token RUNE is down 89% from the top. The Solana high performance L1 blockchain, their token SOL dropped 87%. Celsius, with their yield and zero cost swaps, their token CEL is down a staggering 94.7% from top to bottom here. And so on and so forth. This list goes on almost without any exception. Nothing has changed in any of those 5 projects, to my knowledge. Yet the coins are down like crazy. So my strong insight that I really wish to convey to you is that you have to separate the what from the when. Just because it's a great project with real chances of making it big, please really take in these 2 things. Number 1, if you approach this crypto market only from a fundamental perspective, you're going to get 90% drawdowns, 95% drawdowns, or 99% drawdowns. Almost guaranteed. even if the project is successful in the end. Like the example with ETH. Ethereum, the project, is still fine, still the dominating smart contract platform. 2. The hodl argument is often applied with a survival bias, meaning that you apply it onto something that is doing fine, like Bitcoin. But what if you apply that on something which doesn't make it in the end? Like Luna 1, which had a 100% drawdown. Then hodl is very risky. You actually risk 100% of the position. Because remember that the odds of any tech startup making it is very small. Most tech fails. So the process that I've developed and that I open to all of you here is really to separate the what from the when. Hodling through these downtrends frankly doesn't make any sense. Mathematically or in any other sense. It only makes sense for the whales or the founders who want to get out near the top and wants to dump on you. When I say this, the same objection always comes. But what about tax? If you sell and then rebuy, you have to pay capital gains tax, while if you hodl, you don't need to. Yes, correct, you do. But let's look at the numbers. If you, for example, pay 30% capital gains tax, like we have here in Sweden, that means if you have $100, you have $70 left. You have a factor 0.7 left. But if you hold through a 90% drawdown, you have 10 left, or a factor 0.1. That's 1/7 of what you had here. And if you hold through a 95% drawdown, you have 5 left, or a factor 0.05. That's 1/14 of what you would have had after tax if you sold. Also, investigate if there are some tax constructions in your jurisdiction that would better fit this type of market with extremely volatile assets. And don't do that on Twitter or YouTube. I'm not your tax advisor and I'm not your financial advisor. This is really where you need to go to a tax professional for consultation, since this is highly dependent on jurisdiction and on your situation. For example, for me, here in Sweden, we have something called ISK. You can't put Bitcoin in that, but you can put a Bitcoin price tracking certificate, which is similar to an ETP or ETF, and it trades here on Nasdaq Nordic. Then it's managed through my bank, not very cypherpunk, and it's closed on weekends, which is a huge disadvantage, and there's a counterparty risk. But then the tax model is different. Instead of paying capital gains tax on the profits and deduct some of the losses, you pay a small percentage of the entire portfolio instead. For a slow-moving bond or something, perhaps that wouldn't be very good. But for a highly volatile asset like tech stocks or crypto certificates, that gives you this flexibility of moving in and out of positions without incurring a tax penalty each time. This specific construction is specific to my country, but many countries have something called capital insurance with similar setups. And almost all countries have pension accounts. Can you use that for some share of your capital management? Maybe for the money you don't expect to use yourself, but maybe want to pass on to a future generation one day. Or is there a possibility to do your investment in a capital management company? What happens with tax then? Definitely go investigate all those options. And as I just showed you, even if nothing of that is available, it has so far been better to protect your capital than holding on the way down, in these crypto markets specifically, on average. Of course, this could change in the future, but personally I doubt it for those reasons I explained. Coins are not stocks. That means that they don't have a fair value in that sense. So I think the volatility will continue. Now let's look at the markets. I actually disagree completely with everyone who are so sure what will happen next to the stock markets and the crypto markets. If it was beyond doubt that Nasdaq or the S&P 500 will continue down. No, actually let's take an example instead. Apple now is worth $149. If it was beyond doubt that Apple stock will be worth $75 in 6 months because recession and whatnot, well, then it would be worth $75 today. And it's not. You don't know what will happen next, and neither do I. So let's keep an open mind instead and react to what actually happens. Bitcoin price action then. Right now, as I'm recording this, nothing has really changed. I'm still waiting for the resolution of this consolidation area here. In the newsletter last Friday, I talked about these two possible interpretations. Either this is a descending triangle that has not broken down and confirmed. Then this looks pretty good. The drops below the horizontal boundary were quickly reversed, and now we have signs of an upside breakout instead. So that's good, but for this interpretation to be completely invalidated, we need to break above this level here. Why is that? Because otherwise we could redraw it like this, and it would still be a descending triangle. So 31,500 something is really key here. If we go back to daily candles, the other interpretation is that this is a rectangle, a range. And the rectangle can be a strong bottom formation, but for now it has not yet broken out. Just hit the upper boundary of resistance yet one more time, and so far been rejected one more time. If it breaks up here and closes and doesn't immediately BART back down like it did here, that would be a very, very good sign. As you know, I actually took a gamble entry here in this 30k, 29k region. I reduced it back a little bit when there wasn't immediately a bounce back similar to the previous range touches. But I still hold most of it. However, I have zero tolerance to hold it on the way down, because this was not a high confidence entry at the beginning of an uptrend. If this continues up here, Larsson line will turn gold, and that's where I will add the rest with high confidence. About 1% of the subscribers here have now completed the course and have the Larsson line process and indicator. I'm very happy about that, and I understand that's a pretty high number because most people on social media are rather passive participants, watching mostly for entertainment or just playing around a little, or they still honor the dream that you can just jump on social media and hear about some random project, buy and forget and get rich with zero effort required. And that's just not true. In the best case, you'll end up buying a good project at the top and then sell them at the bottom if you do that. As everyone who have been in the markets for a longer period knows, if you don't have a methodology and you don't have any tools to combat your emotions, if you don't take action when the market structure changes, you're not going to make it in the long run. So my target is that 10% of you guys who are followers here should have a process and a tool set. Doesn't have to be mine. Maybe you don't like my style or my process, and that is absolutely fine. But then you have to get another one. For the 1% of you who have completed the course, I have an update for you today. The 5 most common requests for more details are these. More details on position sizing, more details on stop loss strategy, more about correlated entries, rebalancing, profit taking. You talked, I listened. So today I've replaced the old episode 21 with a newly recorded episode with hopefully the most common questions answered on these topics. The old episode 21 is now episode 22. For the ones who haven't taken the course, please don't fall for the scammers. There are scam sites now, so please triple check the URL www.ctolarsson.com. Everything else is a scam. I have gotten verified check marks on both the YouTube and Twitter channels now, so hopefully it should be a little easier to see which comments are actually from me and which are scammers. Thank you, tack. CTO Larsson out. Hej då!